I am not sure how this year came and went, but here we are. Year-end tax planning is upon us. This is the Issues Watch podcast. Hello, and welcome to the Issues Watch podcast. My name is Nicole DeRosa, tax partner at WIS, and I am very excited to be your host for the tax episodes. Today, we have a very special guest on the podcast, Laurie Smith. Laurie is a colleague of mine at WIS and also a tax partner who will be discussing various year-end planning tips for us today. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of the NJCPA or of WIS & Company. So, Laurie, why don't you start us off with some items for individuals that they should be thinking about as we get close to the year end in terms of tax planning?
Great. Thanks, Nicole, and thanks for having me. Individuals should consider minimizing their tax bills by shifting income or deductions between 2023 and 2024 to the extent they can control those items. Ideally, income should be received in a year where you'll be in a lower tax rate, and expenses should be paid in a year where you will be in a higher tax rate. Some ideas are bunching itemized deductions. If 2023 will be a high income year for you, consider accelerating deductions before year end, such as charitable donations or mortgage interest. Consider giving more to a charitable organization in one year instead of over a few different years to reduce your income in a high income year and receive a greater benefit of those deductions, especially if you're close to utilizing the standard deduction. If you expect your income to decrease in 2024, try to push any additional income to the next tax year if you're able to. Defer commission income or delay closing capital gain transactions to a year where you expect your income to be lower, and that can help reduce your overall tax bill. Work with your accountant and financial advisors to determine if you should trigger any capital losses before the year end to offset any 2023 capital gains as well.
Great point there. I don't know about you, I'm sure you have been, but a lot of my clients have been asking me as of late about, hey, what's my capital loss carry forward? Because my advisor wants to offset. I'm like, oh yeah, here it is. Go have fun. So great point there. Now, what about retirement plan contributions, RMDs, and possible even Roth conversions?
Yeah, another great point. So individuals should consider maximizing their annual contributions to qualified retirement plans and individual retirement accounts to help minimize their tax bill as well. The maximum amount of elective contributions that an employee can make in 2023 to a 401k or 403b plan is $22,500. And that's $30,000 if you're age 50 or over and your plan allows for catch-up contributions. Traditional and Roth IRAs also received an increase due to inflation adjustments, and the maximum contributions to these accounts are up to $6,500, which is up from $6,000 last year. Catch-up contributions to these IRAs remain at $1,000. Beginning in 2023, the Secure Act 2.0 raised the age that a taxpayer must begin taking required minimum distributions, or RMDs, to age 73. The rules can get tricky depending on when a taxpayer turns 72, so it's always best to check with your accountant and financial advisor to determine what rules apply to you and the timing of your required minimum distributions. Now, a planning tip for those individuals that are required to take RMDs but may not necessarily need the money and are interested in giving some to charities. Individuals that are age 70 and a half or older can donate up to $100,000 to a qualified charity directly from a taxable IRA. This has an immediate tax benefit because the portion that's donated directly to a qualified charity from your IRA does not count as taxable income to you. Now, you brought up a good point about Roth conversions. So if the stock market is underperforming, it may be advantageous to convert a traditional IRA or 401k to a Roth IRA. When the stock market is down, the value of these plans has usually decreased and may enable a taxpayer to convert a greater amount than he or she normally would be able to. But remember, some or all of the conversion will be subject to ordinary income tax rates. If you can couple a conversion in a stock market downturn along with a lower income year in the same tax year, that could be very advantageous. Once you convert these Roth IRA to a Roth IRA account and pay the applicable tax costs, the account will continue to grow tax-free. And remember, one of the greatest attributes of a Roth IRA is that you are not required to take RMDs. So as these accounts can continue to grow tax-free, you'll be able to use these to transfer wealth to younger generations as well.
Great points there. Especially don't leave those potential backdoor Roth conversions on the table if it makes sense. Obviously, don't just do it and then tell your CPA after the fact. I love when our clients go rogue on us and they just do things and then it's like, oh, by the way, I did this. And you're like, oh, no. But all right, let's switch gears now and round this podcast out and talk about some year-end planning strategies for businesses.
Sure. So in the business world, you may or may not have heard all the talk about the bonus depreciation phase out. So actually, Congress is considering some legislation that would delay the ongoing phase out of bonus depreciation, but a lot of uncertainty still remains. And as you may as well know as the rest of us, you can only plan for what the law says today. So in 2023, businesses can write off up to 80% of the purchase price of an asset placed into service during that calendar year. Now that's set to decrease to 60% in 2024. So one way to get immediate tax savings is to push forward the purchase of any of these new assets your business may be considering before the end of this year to receive a greater write-off. Another reminder for businesses is the tax deduction for meals is back down to 50%. So keep that in mind when considering going out to lunch. There will also be a new question on the partnership and S-Corp tax returns concerning digital assets. So those questions are going to be very similar to those we've already seen on the 1040. So not new to us necessarily, but it will be new to those business tax forms. Also, be sure to take note of the inflation adjustments for Section 179.
Great. Yeah, the tax deduction for meals, I feel like that's kind of going to be a little bit of a shocker for some people, just because for 2 years, we all got used to just 100% tax deduction for meals. We didn't have to M1 it out. We didn't have to, worry about breaking it out into a separate account. So definitely for 2023, hopefully you guys all told your clients at this point. But if you didn't, make sure to tell them now so that they are a little bit more aware and there's no surprises there on their tax return. So awesome. Laurie, thank you so much. I know this is a lot of information to digest. Thank you so much for sharing your knowledge with us here today. And thank you also for all of you that are watching and listening to today's podcast. You can get much, much more year-end planning guidance by visiting njcpa.org/hub/year-end. Trust me, we just grazed the surface today. There is a lot more where this came from. For the latest and greatest tax news and articles, feel free to visit njcpa.org/hub/tax. And if you are an NJCPA member, be sure to join the Society's federal taxation and/or state taxation interest groups by going to njcpa.org/group. It's a great way to get some extra CPE now that we're, obviously nearing the triennial period. We will be back with a new tax episode soon. You can access all Issues Watch podcast episodes at njcpa.org/podcast. Happy tax planning, everyone, and happy holidays.